Hello, welcome to the Market Carver. I'm Adam Harter, Chief Investment Officer, along with Andrew Thrasher, Chartered Technician and Portfolio Manager. So thankful for you giving us a few minutes of your time here for the last Market Carver of the first quarter. Flipping the page already to April and a fresh quarter. I know that's a couple of nerds like Andrew and I are. We look forward to a fresh quarter for our record book. But as we go into that, here's some things that we're looking at going into the quarter. We've got a couple of real estate points for you. First on the commercial side and then the residential side. Right, both have a lot potentially going on this year as we kind of work through some of the adjustments we had in stock and bond markets, working its way somewhat through the real estate market. And then Andrew's going to pick up and update you on stock trends. So going into the real estate here, this is a pretty dense topic and a lot to really pack in a Market Carver size bite, but that's our mandate for these few minutes. So that's what we're going to attempt to do. Now, one of the prompts of the reasons to discuss this, if you haven't already, you are likely to hear about the potential trouble later this year in commercial real estate loans. And I want to bring that up because it'll certainly be a topic, but in light of the bank failures that we've seen, it can become concerning when it's painted in the light of just how many of those loans sit in medium-sized banks, which is precisely where a lot of the issues have been in the last several weeks. So it's natural to think, oh my gosh, is that another shoe to drop on those already vulnerable mid-sized bank? And it's reasonable to have that trend. And I'll show up a chart as to really what has this front and center. So we're looking here at the additional interest rate charged to an investment grade. So a pretty credit-worthy commercial-backed borrower. The additional interest that is charged to them relative to Treasury. So over the past several years, 2018, 19, going to have to adjust that small COVID window. I mean, it's a reality, but it was obviously a different, outlier type of impact. But through most of the last several years, it's been very sanguine in this market, meaning not a whole lot of risks being built in, real estate values largely going up, so lenders can kind of ease off and not really have to be uber conservative in their underwriting. But that has begun to change here, and those risk spreads or the additional interest charge is beginning to move up. That will make it more difficult for these borrowers to roll over debt. So when we talk about this $250 billion in commercial real estate debt that's coming due in 2023, it sounds like a lot. It is. But the first thing to understand is that these aren't often like your and I loans when we're paying off our mortgage steadily over, say, 30 years. Most commercial debt is done in big chunks. And every few years, they have to reissue or reloan that money, say a 5-year note, that in another 5 years, they're going to have to roll over. So it's an ongoing process. So a lot of that's going to come due this year that has to be rolled over. And the higher the interest rate they're facing, right, the more trouble they'll be in. And coupled with that, the fact that we've seen property prices begin to adjust downward, as you would expect, given the decline on the public market side, that makes it extra tough for this debt to roll over. But one of the main reasons I want to bring that up is there's no reason to immediately assume that that is going to be another 2008, right? That's where my mind goes, and I'm sure a lot of you, when you see a real estate problems, oh my gosh, are we going back into a 2008? Don't confuse that. There will be pockets, potentially sunken banks down the road, but those should be isolated to people who are exposed to the most vulnerable real estate, that being empty office buildings in large metropolitan areas. So certainly would be at least diligent about having exposure to banks that have that. Most of those have already taken quite a bit of hit anyways. But broadly speaking, a lot of areas in commercial real estate have held up reasonably well. Multifamily homes, because we've underbuilt so many homes, there's still a lot of demand for multifamily homes. Student housing is good. And of course, there's just been gangbuster demand for industrial and warehousing type real estate. So things will adjust going here, but we don't want to paint the picture that just because we have a lot of this debt coming due, and you will hear it if you haven't already, that we're going to immediately see it at 2008. So that's the commercial side. And again, a lot more I'd love to say, but I'll cut myself off for your benefit and move to residential. Because housing then, of course, whether or not you have commercial real estate is one thing. But most of us here, if not all, have exposure to personal real estate and our home values. And a lot of those have seen gains. A report that Andrew was shared earlier this week showing the decline that we've seen in several of those large cities like San Francisco and Seattle have seen a remarkable correction, but they're still up from the bottom of the pre-COVID era. So we have to ask a question: what is the downside? What do we expect for home prices? I think this is one of the most optimistic ways that we can look at home prices. This is a current chart that shows you your home price versus, or national average, I should say, versus a replacement cost. This is a reasonable proxy for whether the housing prices are overvalued or undervalued, because let's say if you have a house that's valued at $500,000 and it would cost you just $200,000 to build one across the street. Well, now we've got a problem. Housing values are overpriced. On the other hand, if yours is worth $200,000 but it costs $500,000 to build, well, there's probably some catch up in prices. What this chart shows you is that we're really about average. We're neither really, really cheap nor really, really expensive on the price to a replacement cost. There are measures which certainly do point to elevated risks in residential real estate, or meaning that the price houses are a little bit above where they should be in a value. And that is basically based on rental values. There's not as much rental income as you would expect given housing prices, but put all that together, I don't think there's any reason to think that there's some softness. Again, those housing prices coming down should turn into another 2007, 2008, right? If you look at this chart, things were really out of whack and really overvalued relative to replacement costs going into that 2008. And just the last positive nugget that I would give you is just think about this real logically. And if you would ask your neighbors, many of them, if you do not as well, I know a lot of you watching have paid off your mortgage and don't have one, but if you were to go ask your neighbors if they did have one, chances are really good that they've got an interest rate that's close to 3%. All right, nobody wants to pay off that, and they will do basically anything they can to avoid having to sell that and go into another house, because the new mortgage would likely be 7%. And so that gives a lot of reasons for not a lot of housing supply to hit the market and really put extreme downward pressure on houses. So that's the optimistic, or maybe the best way I can put our expectation for housing prices. So that's the real estate update. Andrew, pass it over to you to take a look at public stock market.
All right, shifting back to the stock market, just a quick chart here. We won't spend too much time on it. I try to keep things a little bit simpler. Some of my charts can be a little complicated, but I'm trying to get better about it. Here we have a look at the S&P 500, just essentially the broad stock market. And we're looking at the number of stocks that are above their 200-day moving average. The reason we're looking at above that long-term average is that's a common way we can gauge if a stock is in an uptrend or a downtrend. If we have a lot of stocks that are trading above their long-term average, then we can say that a lot of stocks are in uptrends. And if the index as well is in an uptrend, then that's great confirmation. That's what we want to see in a healthy bull market. The opposite is also true. And this is something we saw a lot last year, is that when we start seeing a lot of stocks below their long-term moving average, then we can say that a lot of stocks are in downtrends. And that was the case again in a big chunk of 2022, which you can see on the bottom part of this chart, where we saw the majority of stocks, we had less than half above their 200-day moving average. And so as we're starting to get a bounce now in the stock market, we saw the S&P is kind of going back and forth above its own long-term average. We want to start seeing a lot more individual stocks begin to confirm the strength that the index began to show. And so far, we're not seeing that, unfortunately. That very well could change this week or next week, and we sure hope it does. But right now, we're still seeing the majority of stocks, about 40%, we only have about 40% that are above their long-term average, suggesting to say that only about 40% of the market now is in an uptrend. And so as we start seeing where the market's going to go next, we spend a lot of time on the market Carver in our allocation meeting, really discussing how the market's in this consolidation, this kind of whipsawing price action behavior where it goes up a couple days and drops back down, not really making a lot of progress. And we're still kind of in that environment. I likened it recently to trying to drive in fog, to where you can see a little bit, but you can't see real far in front of you. That's the type of environment we're in right now for the stock market, where we're just kind of backfilling, going 2 steps forward, 2 steps back, and not making a lot of progress. And so we can look at the individual stock trends with that bottom panel of this chart showing to really gauge the health of the market. And if we start seeing a lot of strength on the individual stock side, that should translate well into potential strength for the index. And again, we're not there yet. We're getting close, but we hopefully start seeing more stocks move back up in uptrends, and that translates into some positive trends for the broad market as well.
Great. Thank you for that update as always. And thank you to all of you for watching, giving us a few minutes of your moment. Hopefully we'll see many of you here in the next couple of weeks at a Thirdly, and if not in person, at one of our digital showings. So once again, thank you. If you haven't been in to see us, don't forget, as always, give us a call, 800-928-4001. Be happy to see you. So thank you and have a great weekend.